Hi, everyone. Welcome to Finances of a Lawncare Company, presented by Dan Gordon, Turf Books Planet Consultant member. This webinar is hosted by Planet, the Professional Lawncare Network. My name is Betsy Demerit, and I will be your moderator. Before we begin, I'd like to cover a few housekeeping items. First, we encourage you to use the chat panel located in the bottom right-hand corner of the control panel on your screen. To ask a question, click on the chat box and type in your request. Then click the Send Privately box and direct your question to me, Betsy Demerit. We'll answer your questions towards the end of the webinar. If we run out of time, we will follow up with you via email. All telephone lines are mute for this call. This webinar is being recorded. If you are a Planet member, you may access it online in the Member Center section starting next week. And now I'll turn the microphone over to Dan.
Hey, good afternoon. Thanks, Betsy. My background is that I'm a CPA, and I work with lawn care companies all over the country, and we work with various dispatch programs, and we also work with QuickBooks. We're certified QuickBooks Pro advisors, which kind of puts us in a unique position in that not only can we look at bookkeeping, but we can kind of understand what the finances are of of running a land care company, as well as some of the QuickBooks type things that are important in terms of financial performance. So what I've got here is my overview, and the overview is let's just make a simple assumption that everybody here wants to grow their business. Okay, so what resources are required, and then we'll talk about how do we measure financial performance, marketing performance, sales performance, and operational performance. And then we will take some questions. Okay, so now, anybody who's ever seen me speak before knows that I start out every single one of my webinars or seminars with a basic question: is why are we in business? And the only reason you're in business is to maximize the value of your business, period, and there's no other reason. And you could say, well, that sounds kind of selfish, but the fact is that in maximizing the value of your business, I provide a great place to work. I increase salaries and benefits for my employees, creating job security, and I do business in a socially responsible manner. Okay, so we're making a couple of assumptions: that we want to grow our company and that we want to maximize the value of our business. And it kind of makes sense if you think about it. Companies that have one foot in the grave are not necessarily great places to work, and they definitely don't provide job security, and you don't see them, working the local charities and donating to the Little Leagues and to hospitals and things like that. Those who are doing well are doing all of those things. So if you maximize the value of your company, then one of the effects is that all these great things happen, okay, or for the effects. Now, so how do we run a successful business with a recurring revenue model? Now, I know there's probably some folks on the call who do hardscape and whatnot, and there's plenty of money in that, and we can talk about that as well. But one of the things that I like is I like recurring business. I like the maintenance model. I like the lawn care model, fertilization, that kind of thing. Anything that recurs, and even if that recurrence is once a year, or twice a year, a spring and fall cleanup or something like that. I like that type of business because it's predictable. I also like doing construction and hardscape because the margins can be compelling, but it's not recurring, and so each job has to be taken on it's own, and you have to make sure that you're making profit. So let's just talk about recurring business for a model for a second. It's a pretty easy business, but it's not simple to run, or rather it's a simple business, but it's not easy to run, meaning that if we keep putting on recurring business, such as maintenance accounts, fertilization accounts, and whatnot, we're going to build this book of business. When I say it's not easy, well, anytime you run a service business, you're dealing with employees, and employees are a very there's a bit of a trick to running a business with lots of employees, because you always have issues and whatnot. So the business model is simple, but but running it is not easy. Okay. So if we look at the what it is that we're doing for the recurring business model, we need to understand how we're going to sell that. So what we're looking for is to identify a customer need, whether that need is to fertilize a lawn, get a 5 or 7 step program, whether it's to provide lawn cutting services, whether it's to build a beautiful backyard, set up with a pool and everything else. So you have to identify the need. You have to provide the solution, which is your 5-step program or your weekly mowing or a sophisticated proposal that includes all of the work that it takes to create that backyard. Okay, and what I like to do is to then set the customer up on a service contract, and that could come out of a hardscape job, meaning that if you do this backyard, can you put them on the lawn care and maintenance, whatnot. And then when you're creating these recurring services, you do this over and over again until you build a route or several routes. Now, we're going to get into the nuts and bolts of finances in a few, but the concept of selling time, because that's essentially what we do. We sell time and materials, right? Now, the fact is that when you're selling your technician's time, it's a perishable commodity. Once it's gone, you can't resell it, meaning that if I don't make good use of my people, make sure that they're on the job and chargeable, okay, then I'm not selling what my inventory has. It's kind of like having a fruit stand. You have a fruit stand and you've got a few days to sell that fruit or otherwise it goes rotten. Well, when you sell time, I can't get a half hour's time ago back now. Once it's gone, it's gone. So the most important thing to do is to make sure that all of your folks are efficiently routed and on the job, and so that you can maximize the amount of time that you can sell. In fact, if you think about it, you can say, well, I've got 10 guys and they have 8 hours in a day, and what's my hourly billing rate? And you can figure out how much do I bring in on labor each day, and that's a very important metric. You can also do that with your materials as well. Okay. Now, so if we assume that we want to grow this business, there's several areas that we can grow. And one of the things that we want to do is, can we grow number of employees? Can we grow our sales? Can we grow our current income? Or can we increase the value of our firm, right? Growing the number of employees without increasing profitability or revenue, nobody wants to do that. We're basically killing our profit. Are we growing our sales? I hear over and over again, well, I took that job because I know it's not profitable, but I want to keep everybody busy. Well, you may be better off, you don't want to take unprofitable work just because to keep everybody busy. It's always you always want to look for profitable work, and if you take unprofitable work just to keep people busy, those customers are always going to look for you to take unprofitable work. It's kind of like when I used to own a lawn care company, and we had a guy who beat us down pretty severely and then wouldn't pay his bills. And then we looked to make a deal with him to get our bills paid. And he said, "Look, if you take 10% off of off of what I owe you, then I'm happy to give you more properties." And my reply was, "Well, why would I want more unprofitable work?" So be careful when you try to take that work just to keep people busy. That's not a good approach to building a business. Okay, so am I growing my current income? We're going to go into that and how all of that works. But am I increasing the value of the firm? Okay, so we're going to talk about how you value a firm. But I think that the last two, growing current income and increasing the value of the firm, are the two areas where most people would be interested in. Okay, so now let's assume that we're going to grow the value of our firm. And how do we measure the value of our firm? And I'm going to give you an accounting approach to measuring the value of my firm. Okay, so one of the things when we talk about financial statements, most people, even non-accountants, can read a profit and loss statement and get the gist of it. Basically, a profit and loss statement is set up with revenues, meaning the money that's coming in from customer work, less expenses equals net income. Okay, that's the gist of it. But most people don't understand this mysterious thing called the balance sheet. Okay, and if your balance sheet's wrong, your profit and loss statement is wrong. So it's important that you understand this balance sheet. And basically, there's an accounting equation, and that accounting equation is assets equal liabilities plus owner's equity. Now, if you don't understand that, no problem. I'm going to explain it right here. So assets. I buy a house for $300,000. Liabilities. I put a $200,000 mortgage on it. Owner's equity is $100,000. Okay, so the house I buy is $300,000. Basically, I put down $100,000, and I take a $200,000 mortgage. Okay, so the liabilities plus the owner's equity equals $300,000, and the asset value equals $300,000. Now you have to be careful because accountants record things on a balance sheet on what they call historic costs. Historic costs means that's the purchase price when it was purchased. So if you bought a vehicle 5 years ago, the amount that you paid for that vehicle, that's sitting on your books. Obviously, you're depreciating it, but you're not adjusting it up or down to market value. Same thing with a building. Prior to the crash of the real estate market several years ago, you buy a building for $300,000, and in 5 years it could be worth $500,000. On your books, it's still $300,000. So you have to be very careful with that. Now, so that assets equals liabilities plus owner equity is one way that some folks value businesses. They say, okay, what is the owner's equity? That means that's the value of your business. Well, one of the things, there's nothing further from the truth than that, because the fact of the matter is, in a service business, our biggest asset is not on the balance sheet. Our biggest asset is really our customer list and our customer relationships and the goodwill that we've built up in the community and whatnot, right? So that's nowhere on your balance sheet, okay? But it's not something that you can touch or feel or hold, or that a bank can put a lien on. So that's one of the reasons that banks don't really like the service business unless they can touch or feel or repossess something. So if you're buying big machinery, big equipment, you're buying backhoes and things like that, sure, they'll give you a loan. They have something that they can take when you don't pay. If you're looking for an unsecured credit line, that's when they start scrutinizing you a whole lot more. And the reason is because there's nothing that they can take. Well, you could say that they could take your business, they could take your accounts receivable, but if you're in a position where the bank has to take that stuff, your company's probably not doing real well anyway, okay? So, how then do we value that intangible asset? So we could say that the book value is the value of the company, but we all know that that's not right. But how do you value a recurring revenue business? Okay, consider this: that the selling price of many service firms can be equal to about 1 year's gross revenue. So if you were in the maintenance business, there's a multiple that the big boys would pay for you. If you're in the lawn care, the fertilization business, there's a multiple that the big guys would pay for you. Okay, and that's a percentage of revenue. Usually in the fertilization business, it's usually around 1 times annual revenue. Okay, so if the selling price of the service firm can be equal to 1 year's gross revenue, if you grew your firm's sales by $250,000 last year, you've increased your net worth or your wealth by $250,000. Okay? One of the things that we find is that most people who are in small businesses, service firms, they don't have these big 401ks. They don't work for IBM and all their stock is put into a pension plan. Their pension plan is basically the value of their business when they get to retirement age, whether they cash out and sell out to one of the big boys or to a family member or anything like that. So we know that if one of these big guys are going to purchase you, they're going to purchase you for the value of that recurring revenue. Now, on the other side, if you run a construction company and you do a lot of hardscape and non-recurring business, a lot of what you can sell is the value of the equipment plus maybe some goodwill, okay? But you can see that to build long-term value, this recurring model is pretty powerful. So the gross revenue, it's not just recurring, it's got to be profitable recurring work. So one-shot work is helpful in meeting current expenses, but it adds very little value to your firm. Okay. Now, the customer list, it's the most valued asset. Okay, long-term, it can be compared to the machinery in a manufacturing business. It has to be well-oiled by providing great services. Okay, the routes need to be tight, allowing for the greatest output from this machine. And short-term, it can be compared to a life insurance salesman setting up a book of renewable policies that generate current income. Okay. Now, you need a plan. If we're going to grow our business, you need a plan, and the plan has to focus on growing that customer list or the goodwill, as well as selling more to existing customers. So one of the things that we get out of our finances or that we look at our customer base, we have to say, what's our average revenue per customer? And we baseline that. And then we say, well, how can we sell more to that customer? So let's say that average is $500 a year. How can we go to $550 or $600 or $700? Can we sell them more of what they're currently buying? Can we offer other services? If we're in the fertilization business, can we offer aeration? Can we offer overseeding? If we're in the maintenance business, can we offer them pruning? Those kinds of things, okay? And if we're building, every time we build something, we should be looking for that maintenance contract from that customer. We just built them a beautiful backyard. Why shouldn't we be doing their lawn cutting or their fertilization and whatnot? Okay, so what we have to remember is that we're not in a high margin business. I wish I could tell you that we were, but we're in a moderate margin business where we generate high profits from customers that use our service on a scheduled recurring basis. Okay, so consider this. What does it take? It costs anywhere from $80 to $500 to generate a lead from various sources. So which is better, a one-time at $500 or an ongoing service agreement at $75? Okay, so I kind of like that recurring model. Okay, now if you buy into what I'm saying on this recurring business model, let's see what it would take to grow our business. And by the way, the cool thing about the recurring business model is that it is, once you build it, you don't have the ups and downs that you have trying to constantly look for this one-time work and keep people busy. And you're not as prone to the ups and downs of the short-term economy, right? So if usually if you have a book of business, yeah, you're going to lose some people when the economy goes south, but it happens a lot. It's much more manageable than if you're looking for construction projects and 2008 happens and everything dries up. So let's go into this. I'm going to make a couple of assumptions here. So I'm going to say that my average revenue per customer is $500 a year, and my cost to acquire, meaning my marketing, is $250. Okay. Now, most of you are going to look at me and say, $250, you're kind of out of your mind. And I would say you're right. But what I want to show you is that, with higher numbers so that you can add your own numbers. But basically, let's say my average revenue per customer is $500. My cost to acquire a customer is $250. Okay. My average expansion goals, I want to double my revenue over 4 years, which is actually 20% per year compounded, not 25%. And I'm going to make a really, really bad or unrealistic assumption, and that is that I have 100% retention. So let's say I start the year at $500,000 of business, meaning that I have 1,000 contracts. 1,000 times 500 is 500,000. Okay, and so year one in my program here, I need to grow 20%. So I need 200 new customers. That 200 new customers, okay, will get me my 20% growth. It'll go from 500 to 600,000 here, okay. But I'm going to need $50,000 to do it. My 200 times 250, okay. So I'm going to need $50,000 to get there. Year two, I want to grow 20% of the 600,000, so we'll get to 720. I need another 240 customers, or those 240 customers, that's going to cost me $60,000 in marketing, okay? Year three, I need another 288 customers. It's going to cost me $72,000. And year four, I'm going to need another 345 customers, so it's going to cost me $86,000, okay? So what have I done? I've doubled my business. But in the meantime, look at how much money that I've spent. I've spent 50, 60, that's 110, plus 72 is 182, plus another 86 is 260, over 200, almost $270,000 to do this, okay? So the question that I have is, where does the money come from to do this, okay? Well, if your plan isn't quite this aggressive, you can pay for it out of cash flow, okay? But the fact of the matter is, in any service business, your bottom line, especially in our business, can be anywhere from 5% up to, say, 20 to 25% if you're a real small company and the owner's doing quite a bit of the work, okay? But if you go beyond that, then you're going to take all your profit, put it into marketing, and you're not going to have any profit at all. So you can fund your marketing through daily operations. However, if you have a very aggressive plan, you're going to have to finance it through a bank, i.e. a credit line, or maybe finding a partner or somebody else who will lend you the money. But it's really important that you think about, where's the money going to come from? You can't just say, okay, I'll just take it out of the bank as it comes in, okay? Now, one of the things that we like to do, and I talked about this before, is we like to make sure that all of our customers are, or that our company is profitable. So we benchmark our revenue per customer. Most companies look at revenue for the company or revenue for the branch and determine profitability from there. In other words, what I do is I take all of my whole company and I say, how much did I do in revenue? What's the profitability? If it's over 5% or 10% or whatever my threshold is, then I'm happy with it, okay? But the disadvantage to looking at a business this way is you can have unprofitable customers, and you'll never understand your profitability, as you'll always be looking at the sum of the parts as opposed to the parts themselves. Meaning, you can have some great customers that contribute all the profit and then have a bunch of dogs who they actually take money out of your profit, but because those guys who are really profitable add significant money, you're profitable anyway. So I don't like to look at the company as a whole. I like to look at it as customer by customer or job by job, meaning that if you're doing construction, I like to do job costing. And I love QuickBooks because you can do job costing. Okay, QuickBooks is not that good for like a high volume service maintenance company that you need lots of recurring revenue. There are other programs out there, but QuickBooks allows you to job cost. Now, I don't expect you to job cost a $500 a year customer. In fact, I probably wouldn't even job cost a $5,000 a year customer. I would do it for big construction jobs. So one of the things that I look for in my profit per customer is I need a metric, whether it's dollar per hour, or dollar per square foot, or whatever that metric is. I look at a dollar per hour, dollar per square foot per customer, and I look at the revenue per customer per year, and I benchmark that number, and I try to increase that average each year. Again, got a $500 customer who has a maintenance program. I add another $700 for a fertilization program. Or I add another $300 pruning job, or whatever it is that you want to. But you want to baseline your average customer. What does my average customer bring me? And then you want to set some goals that I want to increase that average customer by next year. Okay, so by doing this, you guarantee profitability as well as maximizing each the amount that each customer is spending with you. So one of the things when you're setting up your, I like to use QuickBooks on the, for my expenses, my payroll, anything that's below the revenue line, okay? And if I set up my chart of accounts properly, I should be able to, on a monthly basis or any time, press a button and say, how much money did I make? How much, fertilization or lawn maintenance did I do last year? Can I look in QuickBooks to do that? Or when I look in QuickBooks, do I just see a number called sales? I want to know, how much fertilization did I do? How much lawn maintenance did I do? How much pruning did I do? How much hardscape did I do? Et cetera, et cetera. I want to be able to break that out. What was my labor percentage? How do I figure that out? What's a good labor percentage? Okay, I can tell you in the recurring revenue model, especially in the fertilization business, your labor should be about 15 or 16%, right? Maintenance a little bit higher, construction a little bit higher, okay? What is your material percentage? Well, if you're doing fertilization, what should that be? Should that be somewhere between 13 and 18%, right? Okay. If you're doing construction, it might be 30% or 35%, okay? Or more, depending on how if you do, cost plus, pricing, then it could be significantly more. So at the push of a button, based on your chart of accounts, can you tell me how much money you spent on sales and advertising? Okay. What were your gross and net margins? Okay. Those are things that you're looking for to rate your business. Okay. So a well-designed profit and loss statement includes revenue broken up by department with recurring and non-recurring revenue, meaning that we said before, fertilization services, maintenance services, pruning services, all the different services that you have, minus your direct cost. What is a direct cost? That's a cost associated with putting a truck on the road and performing services. What goes into that? Well, what goes into that is the technician salary, whatever you're paying him, the payroll tax associated with that, any benefits that you're giving him, his uniform, the material he's using, anything that goes on that truck and goes out to a customer's house is your gross margin. Your revenue minus your gross margin, your revenue minus your direct cost is your gross margin. Okay, that gross margin needs to be at a maintainable amount, and if you're in the recurring business model, that gross margin you should shoot for about 50%. Okay, and then from that you take your sales and marketing as well as the office costs, all the costs associated with office operations, and that gives you your earnings before income or interest, taxes, and amortization. Then you take those non-cash charges. By the way, if I'm speaking, obviously if you've been in business, you've heard these terms. If you're not 100% clear on them, you can give me a call if you need help. I'm happy to help. We're always taking new clients, but we also do quite a bit of helping folks who are non-clients. And I write quite a few articles in landscape management and lawn and landscape, so you can see the articles that we have there. So that after we subtract out those non-cash charges, we get our net income. Okay. So what are the most important things that I look for? So break it down. That if you don't understand it, that's fine. But here's what here's the takeaway. If there's anything that you should take away from this meeting, it's what am I looking at? I want to look at gross margins. That's revenue minus direct costs, okay? I want to look at my labor, okay? There's one sure way to make money in this business, and that is to control your labor. There's one sure way to lose money in this business, and that is not to control your labor, okay? I want to look at my material costs. I want to look at my selling costs in two ways. I want to look at marketing as well as sales and commissions, okay, my salespeople. So there's two, marketing is different than sales. Marketing is everything that you do to bring in the lead. That's all your advertising, you know, your internet marketing, your magazines, TV, radio, whatever it is that you do. Selling is, that's once the lead comes in, what are you doing to close it? Okay, so those things need to be separated out. I also like to look at my office labor as a percentage of revenue and all my other general and administrative percentages, my general and administrative cost as a percentage of revenue. What does it cost to run an office? Well, I'm going to tell you an efficient office is running about 20%, okay? So 20% of your revenue it takes to run your office, meaning all your customer service reps, the telephone, the electricity, the rent, everything, all that kind of thing, okay? Now, why is it so important to set up your profit and loss using this revenue minus direct cost equals gross margin, minus sales costs, minus G&A equals net income? Why is it important? Because it allows us to make accurate conclusions about how our management staff is executing our business strategy, okay? It allows us to isolate revenue types that will add to the value of our business, meaning the recurring versus the non-recurring. It allows us to isolate expense types so that we can implement cost controls, okay? How can we implement cost controls if we don't know what those costs are as a percentage of revenue? I can't, if my fuel costs are 6% and I want to get them to 5%, I can't get them to 5% unless I know that they're 6%. So I isolate that on my profit and loss and then work on drilling it down, okay? Other reasons why you wanted to be able to have this kind of information is it allows you, you know, to create management and bonus incentive structures. One of the things that I do when I walk into a lot of smaller clients especially, I'm introduced to their manager. Well, what does your manager do? You know, he kind of runs the operation. And then when I sit with him for a while, what I see is all he is a big firefighter. He goes and he handles all of the customer problems, and all day long that's what he's doing. A manager, that's not a manager. That's a supervisor. A manager is the guy who makes sure that there's, you know, that we're sending this much work out each day with this much revenue and profitability. Make sure that you know, everybody is doing tasks that increase our revenue and profitability. That's what a manager does. A manager does not, you know, I'm not saying that you can't solve customer problems, but if that's all he's doing all day, then he's not a manager, and it really doesn't matter that we have a bonus and incentive structure, right? That bonus and incentive structure should be based on the number of problems he solves, customer problems, rather than the profit we make. But the good guys, the guys who are worth their salt, those are the guys who want to make money because they're going to get some sort of derivative from the profit, okay? It also allows us to determine which services are profitable and why, and it allows us to consistently value our company, meaning what's, you know, what is profitable and or what is recurring and what is not recurring. And again, specific improvements needed, meaning that if my fuel cost is 6%, I want to get it to 5%. Or you go to you know, a planet meeting and you talk with your peers and they all say, you know, I do a lawn care business and our fertilization costs are 13%. Well, geez, ours are 18%. Well, how do you get it to 13%? You've got to make sure that you're talking the same language. You know, you've got to make sure that all of the costs are accumulated the same ways, or otherwise you're talking about apples and oranges, and that becomes very frustrating. So a uniform chart of accounts and it is extremely helpful. And if you're interested in that, by the way, give us a call. We can send you some of the sample reports that we do for our clients. Okay. Now, let's go into let's get off of that topic for a minute and go into accounts receivable. How do we rate our accounts receivable? Well, traditionally, most people say, well, we age them. We say 30, 60, or 90 days and a percentage of total. So if my under 90 days or my over 90 days is over 8% or 5%, then we're not doing so good, right? Or it's based off of this 30, 60, 90. Okay, so we can try to improve these percentages. Clearly, we want to get that over 90 down to 0 if we can. Okay, but one of the things that there's another way to rate your receivables, and that is keeping your customers within terms using a ratio called number of days sales and receivables. Now watch this. If I say that my customers can have 30-day terms, that means I do the work and I give them 30 days to pay. And usually in the commercial arena, that's the way it works. Residential, hopefully you're getting paid either before the job or you're getting paid COD. But in commercial, you've got to send in your invoice and it gets paid and you give a 30-day collection period. So what happens? So let's say that I have a business that's doing $360,000 a year, or about $1,000 a day. Okay, so that means my $1,000 a day is that's my sales per day. So if I have a if I have $30,000 of receivables, that means I have 30 days in receivables. So if my terms are 30 days, then I can actually, then my receivables are healthy. If it's 40 days, well, that means that people are taking advantage of me and that we're giving folks 10 days more than they should. Our receivables aren't so healthy. On the other hand, if I have 20 days, then that means that we're in pretty good shape. Now, if you have a combination residential and commercial company, that 30 day, if you offer 30 days, that 30 days, I'm going to tell you, should be around 15 or 16 days because the residential component of it brings it way down. Residential folks should be either paying prior to service or at service, okay? And I have this is actually a calculation of off of a actual client data, but basically in January we have 30 days in the year, and my cumulative days or my cumulative sales is $141,000, and so basically what I'm showing here is that how my days in receivables act. And by the way, give me a call if I'm not going to go through this whole example, but essentially it happens seasonally. Okay, so if most of your residential work is during the summer and spring, which most of it is, that days in receivable is going to be lower than in the winter because you have more commercial work, and so you're giving more terms out. Okay, so there are two ways to rate receivables. Number one, 30, 60, 90, which most people do, and the other is days of sales in receivables. Okay, now, for those of you who use salespeople, okay, what are important data points? Okay, one of the things that if you don't have any leads, then they have to be creative. Okay, and that makes selling more difficult than if your phone is ringing off the hook and you're just throwing them leads. So what are important data points? One of the important data points is the number of leads that you receive. Number two is the number of leads that you close. Number three is the number of proposals that you write, meaning that if you go out to do a proposal, somebody wants to have a patio built, you give them a proposal for the patio, and then you give them a proposal to mow their lawn, and you give them a proposal for fertilization. That's three proposals off of one lead, okay? And you should be at least 1 for 1, but more probably more than 1 for 1. You should be 2 to 1 or so. Okay, so the other is dollars proposed. How much did I do, and how much did I propose, and then dollars sold. How much did I sell? And then I like to look at the closing percentages. And then just from a managerial perspective, I like to see, well, my sales department cost me $100,000. How much should they have sold? Well, they should have sold probably at least 400,000, but probably 5. So total sales cost of your sales department should be in the 20 to 25% range. Okay. Now, number of leads received to number of leads closed. This is pretty cool because we call that our batting average, meaning that, yeah, we close at a 60% rate. But what if I give out 10 proposals and the first one is for $50,000 and the rest are for $500, and I close all of the ones for $500? So my batting average, or my close percentage, is 90%. So, but I missed that biggie. Okay, so I not only like to look at it as number of leads given over number of leads closed, I like to look at it as number of dollars proposed over number of dollars closed, because that's probably, I like to look at both, so we can see if we're able to close the volume, but also are we able to close the big jobs. Okay, so that's our batting average, number of leads closed over number of leads received. Now, remember, I said before the number of proposals that you write over the leads given. So that would be if we were sent out to the house to do a some sort of construction, but we also proposed lawn care and whatnot. So I call that pitch efficiency. So there's batting average and pitch efficiency. Number of proposals written over number of leads given. Okay. Sales dollars efficiency is, as I said before, dollars sold over dollars proposed. Okay. By the way, anybody who wants a copy of this PowerPoint, because I know I'm going quickly, just email me at dan@turfbooks.com, and I'll be happy to email you a copy of this so that you can look at these ratios closer and the formulas. It's dan@turfbooks.com. Okay. So one of the things that I also look to see is I kind of age my proposals to see how my sales guys are doing. How long is an average proposal sitting on the street? And what happens during the season. You probably don't follow up on things because you're way too busy. But what happens if we introduce telemarketing? What happens if we have somebody in the office making the calls on those proposals that salesman is out doing because he's so busy? I'm going to tell you that your closing rate is going to go way up. Okay. And again, one of the things I want to know is my total sales effort. What does it cost me to make that sales? Base salary plus commission over the total sales. That's my ratio. So I pay a guy, I pay my sales department $100,000. They bring in $500,000. My sales compensation as a percent of sales is 20%. Okay. Now, operational performance. Okay. Here are some metrics that we can use on effective routing. Okay. This is kind of interesting, but basically there's two ways to affect profitability, and that is either you increase your revenues or you decrease your expenses. And you can't always increase your revenues because market conditions won't allow you to, and you can't always decrease your expenses because there's a rock bottom. Gas costs $3.75 a gallon. You're not going to go any lower than that. Right? Maybe you can use less gallonage, but there are certain things that you can't go below. But if you can route your technicians effectively, I'm going to show you how you can actually kind of ghost or mirror this increase in revenue and decrease in expenses and make you more profitable. That's pretty intuitive, meaning that, yeah, if I route people better, I'm going to make more money. But let me just show you the numbers so that if you want to show somebody in your office why this makes sense, again, ask me for this PowerPoint, you can show them. But single largest expense in your company is labor, okay? Now, technicians are either paid an hourly rate or a percentage of their route, okay? And if you're paying them an hourly fee, this fee gets increased by 50% after 40 hours. And by the way, anybody who's interested, you really need to make sure that you're in compliance with the Department of Labor as to how you pay your folks. Okay, so there's several methods of paying folks, but you need to make sure that you're in compliance. And it's worthwhile just to do a little research on that, or call us up. We'll tell you, because we've been through so many Department of Labor audits, I can't tell you. And a lot of people think just because they're paying minimum wage or over that they're in compliance. Not necessarily true. Okay. So now, the idea for us to increase operational performance is to fit more work into less time. And I don't mean to, in any way, shape, or form, to do less quality work. It's just, let's be more efficient. So let's take an example. Let's say I have a technician who earns $15 an hour, and let's say that he can complete one job in an hour that produces $50. So in this case, my labor percentage is 30%. That $15 divided by $50, or 30%. That means for every $100 of revenue, ignoring all other costs, I have a profit of $70. Okay? Now, let's say that that same technician earns $15 an hour, and that he can complete two jobs in an hour that produce $50 each, or $100 total. In this case, my labor percentage is 15%, not 30%, but 15%, because my revenue, I've completed two jobs for $50, and I still pay him $15. Okay, so I've taken my labor cost from 30% to 15% by becoming more efficient. Okay, so by fitting more work into 1 hour, I've been able to increase my profit by $50 an hour. Here I've increased my revenue in dollars. Okay, remember, we increased revenue, and decreased my labor expense as a percentage of revenue just by fitting that extra stop in. I didn't sell anything to a customer. I didn't upsell them. I didn't do anything like that. What I did is I made myself more efficient, and I increased my revenue, and I decreased my costs. Okay? Now, let's say that I have a technician who is paid a percentage of his route. Okay? So some people pay that way. So he earns 25% of his dollars produced, assume, and that he can complete one job in an hour that produces $50. So in this case, my profit is $37.50, ignoring all other costs, and my labor is $12.50, or 25%. Now, let's assume that he can do two jobs. Okay. In this case, my profit is $75. Okay, it's still 25%. My labor is still 25%. However, by fitting more work into an hour, I've been able to increase my profit by $37.50 per hour, from $37.50 to $75. In this case, I've increased my revenue by 50 per hour while holding my labor expense constant as a percentage of revenue. Okay. Now, if you've been in business, in the service business, for a long time, all this stuff makes sense intuitively. How do you show your folks? Okay. Well, you show them with a PowerPoint like this, or you put it on a spreadsheet, because everybody knows that efficiency leads to more profitability. How do you show your folks? How do you get them to buy into it? Okay, and that's what we're doing here. Okay, now the next topic on efficiency is one of the most important benchmarks in judging how efficient routing is called utilization. So a lot of CPA firms and law firms use this. When I worked as a CPA or for a large CPA firm, we did this. And but it fits the model, it fits our industry really perfectly. So utilization is the following fraction: total technician jobs spent on all work during a time period over total hours clocked in. Okay, so you say, well, what does that mean? Okay, that means that if I have a guy running around doing work all day and he spends 6 hours doing the work, okay, and he is in the truck traveling, I call it windshield time, for 2 hours, okay, that would be, he put in 8 hours, but he worked 6. So my fraction would be 6 hours over 8 hours, or 75%, okay? Now, let's say I have a technician who spends 30 hours at various jobs during a week. Let's also assume that according to his time card, he was punched in for 50 hours, okay? And by the way, one of the things that I said before is whether you pay your folks on a percentage of production, whether you use a flex work week, whether you pay hourly, you need to make sure that you're keeping hours. You need to make sure that somebody's punching a time card or that somebody's signing off on a time card, because if you don't, you will be burned by the Department of Labor if you get audited, okay? And you can contact me about that if you'd like, but make sure that you are keeping hours for all technicians, okay? So anyway, getting back to my example, 30 hours on a job, 50 hours total. So my utilization would be 30 over 50 or 60%. That means that he's producing revenue for 60% of the time he was clocked in. So the question is, let's say my average dollar per hour on accounts for the day is 75. With a 60% utilization, I'm actually taking in $45 an hour. So if my technician clocks in for 8 hours, he's going to produce 360 for the day. If his utilization is 75%, okay, then he's going to bring in $450 for the day. If his utilization is 40%, he's only going to bring in $240 for the day. These numbers are using the same $75 an hour, but varying the utilization or the amount of time that he's on the job versus windshield time. Okay, so you can see how important that is. Okay, now this point illustrates the fact that there's two ways of increasing daily revenues. Either you raise your prices, which isn't always feasible because of your market, or you increase your utilization by making your route more efficient. Okay. With that, I'd like to take some questions if anybody has any. Betsy?
We do have one, and I'm sure they're going to start coming in. How do you determine all the percentages you came up with? How do you know which are the right percentages?
The short answer is I've been doing this a while, and I've been focusing. Our focus, we have two brands. One is Turf Books, and the other is PCO Bookkeepers. I owned a pest control and lawn care company. I'm a CPA. We work with over 100 service companies around the country. So I know from all of our clients what those numbers are, and we're pretty accurate. So we know them. The other is, I'll give you guys a plug, Betsy. There's a book that Planet publishes called The Operating Cost Study, and it's really, really good. And Betsy, you can give a plug for that. I'm not exactly sure what I paid for it, but whatever I did pay for it, it's worth its weight in gold.
To be honest, I don't know the actual cost, but I'll check into that and let everybody know. Another question, yeah. Is it better to lay people off than to take on an unprofitable work?
Well, it depends on how much fixed cost you have, but the answer generally is yes. I would rather do that. But there are costs, and they may not be financial costs, in laying people off. If you're running a fertilization company, most understand that they're going to be laid off during the winter and maintenance. If you're running, if you're working for a company that's doing a myriad of service, including snow plowing and whatnot, you're keeping them busy all winter. So there's, if you lay somebody off, you run the risk that he's not going to come back the next year. The other thing is that usually, this is not always the case, but in most cases, you want people who are working for you who are pretty stable. You want a guy who's got a family, who's got a mortgage, who's not going to, fly off the deep handle. And those people generally need a paycheck, for 52 weeks a year. The other negative to laying people off, and depending on how large your company is it will affect your unemployment rate, and so you will pay a higher rate for payroll. And if you're just going to lay a few folks off and you have a large company, that's spread across all of the folks in the company. If you have a smaller company, it's not going to hurt as much.
The next question is, should your plan be written down, and how soon into the plan do you start changing it?
Absolutely, your plan should be written down. I like to do budgets. Like a lot of business coaches and whatnot want to do a full-blown business plan, and I respect that. I think it's great. Evaluate your competition. This is what I want to do. You can't be everything to everybody, so you write all that down. But what I like to see is a budget, I like to see, okay, I'm going to have 500 new clients who are going to pay me $500 a year. That's my revenue budget. So in order to handle those 500 clients, I need this many vehicles because, you know, and in order to this many vehicles, I need this many technicians to drive those vehicles. And I like to work backwards with budgets. And then I like to play what if games. Okay, so what if I don't get those 500 customers? What if I only get 400? What if I get 600? So budgets are built, and I don't think that you should change them so that you can't see the original budget. I think that you should do a version 2, version 3, so that you could say, this is where I started and this is where I'm going.
That seems to be the last question. You have any final comments?
Well, I really enjoyed it. If we are a full-service accounting firm, turfbooks.com, and we really enjoy working with folks in the service business. And if you need any help with taxes or monthly accounting or just getting your books under control, we'd love to talk to you. And,
thanks, Dan, for such a great webinar. In order to improve our future ones, please take a few moments to fill out our evaluation, which will appear on your screen at the end of this call. Thanks, everyone, and have a good day.
Thank you.
The organizer has ended the session, and this call will be disconnected. Goodbye.